What if I told you, the biggest trade of the decade started the day a bomb dropped in Qatar? Overnight, 20% of the world's LNG supply vanished. European gas prices didn't creep up, they surged, 85% in a matter of hours. 700 ships sat frozen in place. And almost no one is talking about the real opportunity this created. Because while everyone was watching missiles, the smart money was watching infrastructure. Let me take you back. February 28, 2026. A coordinated strike changes the balance of power in the Middle East overnight. Within days, retaliation hits where it hurts most, not militaries, but energy. Qatar's Ras Laffan facility, the single largest LNG export hub on Earth, is struck. Production halts. Then comes the second wave. More damage. Fires. Structural impact. And suddenly, this isn't a disruption, it's a multi-year problem. 3 to 5 years. Let that sink in. This isn't oil spiking on headlines. This is physical infrastructure, massive, complex, cryogenic machinery that cannot just be turned back on. You don't restart LNG like flipping a switch. You rebuild it. Slowly. Carefully. Over years. At the same time, Iran effectively shuts down the Strait of Hormuz, one of the most important choke points in global energy. 20% of the world's oil. 20% of LNG. Gone. Or stuck. 700 ships anchored. Trade frozen. Markets scrambling. And in just 96 hours, the global energy map was completely redrawn. Now here's where most investors got it wrong. They chased defense stocks. They bought oil majors. They played the same playbook that's worked since World War II. And for a moment, it worked. Defense stocks surged. Then they gave it all back. Because that trade? It was obvious. It was crowded. And it was already priced in. But this is different. This is not a geopolitical trade. This is an infrastructure trade, disguised as a geopolitical event. Because the real story isn't the war. It's the hole the war created. A massive, structural supply gap in global LNG. And someone has to fill it. Now look at the numbers. US natural gas, $3.91. European gas, over $60 equivalent. That's not a gap. That's a chasm. A 16x price difference. And every cargo shipped across the Atlantic is capturing that spread. Massive margins. Locked-in demand. Desperate buyers. Signing 20-year contracts. Not because they want to, but because they have to. So who wins? Let's break it down. First, Cheniere. This is the backbone. The infrastructure king. Massive export capacity. Nearly all of it already contracted out for years. Stable. Predictable. Dominant. And here's the key, they're expanding. Right now. New capacity coming online directly into the highest priced LNG market in a decade. They're not just benefiting from the crisis, they're scaling into it. Second, Venture Global. This one is different. This is not the safe play. This is the explosive one. Because while others locked in contracts, they kept exposure to the spot market. And right now? Spot prices are on fire. Meaning every shipment they sell today is capturing peak pricing. Real-time profit. That's why the stock doubled. And here's the crazy part, it's still below its IPO price. High risk? Absolutely. Massive debt. Execution matters. But if this environment holds, this is the highest torque play in the entire space. Third, Equinor. The quiet giant. No choke points. No tankers. Just pipelines straight into Europe. At under $2 cost. Selling into a $60 plus market. That's not a margin, that's a printing press. And almost nobody is talking about it. Fourth, ONIOC. This is the infrastructure behind the infrastructure. Pipelines. Processing. Transport. They don't care about price spikes. They care about volume. And if the US is exporting more LNG, they win. Simple as that. Lower risk. Steady cash flow. The sleep at night version of this trade. And finally, Diamondback. Not LNG. Oil. But in a world where crude is pushing $90, $100, cash flow explodes. And they're returning it directly to shareholders. Buybacks. Dividends. Debt reduction. This is pure leverage to higher oil. Now let's zoom out. Because this story doesn't end with LNG. There's a second-order effect here, and almost no one is talking about it. If the Strait of Hormuz can be shut down once, it can be shut down again. And suddenly, countries are asking a different question. Not, how do we transition energy? But, how do we avoid choke points entirely? And that leads to one answer. Nuclear. Because uranium doesn't move like oil. It doesn't rely on massive shipping lanes. The entire daily global supply fits in a few train cars. It's compact, secure, and immune to the kind of disruption we just saw. And here's the shift happening right now. Governments aren't just thinking about clean energy anymore. They're thinking about energy security. And nuclear is the only baseload solution that checks both boxes. So now you have two trades. The immediate one, LNG, driven by a multi-year supply shock. And the long-term one, nuclear, driven by a complete rethink of global energy logistics. But here's the most important part. The market doesn't fully believe this yet. Oil futures are pricing in normalization. A quick resolution. A return to stability. But infrastructure doesn't care about ceasefires. You can sign peace tomorrow, and Ras Laffan is still broken. For years. That's the disconnect. That's the opportunity. The world's energy map was redrawn in 96 hours. Most investors are still looking at the old version. Now you're not.